What's up, my fellow iguanas? In this video, I'm going to reveal the shocking truth about DFI Retail Group's profits. You won't believe the insane growth they've achieved. We're talking a mind-blowing 60% increase in underlying profit year on year. That's some serious cash, folks. But that's not all. I'll also dive deep into the company's performance across different divisions, from the food retail sector to the booming convenience stores. You'll get an inside look at the strategies that helped them double their margins and dominate the market. So grab a snack, get comfortable, and get ready to have your mind blown. This is one retail analysis you won't want to miss. First things first, let's talk about DFI Retail Group's recent performance. Their overall revenue grew by a solid 2% year on year, which is impressive given the challenging economic conditions. But here's where it gets really exciting: their underlying profit skyrocketed by a whopping 60% year on year. That's some serious growth, folks. This remarkable profit surge was driven by better performance across most of DFI Retail Group's subsidiaries. While the food retail division, which includes brands like Welcome, Food World, and Cold Storage, saw a slight dip in same-store sales, they managed to increase their overall pre-tax profit through disciplined margin and cost control measures. The convenience division, led by their 7-Eleven stores in Macau, South China, and Singapore, saw an improvement in same-store sales and more than doubled their profit thanks to a strong sales mix. The health and beauty division, spearheaded by Guardian, also had a stellar performance, posting high single-digit growth in same-store sales and a 20% uplift in profit. This success can be attributed to the recovery in tourism and strong in-store execution. However, the home furnishings division, which includes IKEA, faced challenges due to the macroeconomic environment, with significantly lower profit due to factors like high interest rates, a dampened housing market, and increased outbound travel, particularly in the Hong Kong and Indonesia markets. Despite these challenges, DFI Retail Group remains optimistic about the full year, expecting an underlying profit between $180 million and $220 million. With a diverse portfolio of over 11,000 outlets across Asia, the group and its associates and joint ventures reported total revenue of $26 billion last year, showcasing their resilience and adaptability in the face of economic headwinds. The food retail division, which includes brands like Welcome, Food World in Hong Kong, and Cold Storage in Singapore, saw a slight dip in same-store sales growth compared to the previous year. However, they were able to offset this by implementing disciplined margin and cost control measures, resulting in an overall increase in pre-tax profits. While the division faced headwinds in North Asia due to reduced consumer spending on groceries and increased outbound travel, this was balanced out by positive festive trading performance in Southeast Asia markets. On the other hand, the convenience division, led by the popular 7-Eleven chain, was firing on all cylinders. They reported an increase in same-store sales growth compared to the previous year, driven by strong performance in markets like Macau, South China, and our very own Singapore. What's even more impressive is that their profit more than doubled during this period. This remarkable feat can be attributed to their ability to optimize sales mix and drive operational efficiencies across their convenience store network. The health and beauty division, which houses brands like Guardian Pharmacies, also had a stellar performance. They posted high single-digit growth in same-store sales and a 20% uplift in profits. This impressive growth can be credited to the recovery in tourism across the region, as well as their strong in-store execution strategies that resonated well with customers. The convenience division was absolutely killing it. They saw an increase in same-store sales growth not just in Macau and South China, but even right here in our very own Singapore. And get this, their margins more than doubled. That's some serious efficiency and cost control measures at play. It's like they found a way to squeeze every last drop of profit out of each sale. The health and beauty division also had a stellar performance. They saw same-store sales growth in Malaysia and Indonesia, which is impressive on its own. But what really caught my eye was the boost they got from tourism recovery in North Asia. It just goes to show how interconnected the retail world is these days. When one region bounces back, it can have a ripple effect across the entire industry. Now, the home furnishing division did face some challenges. Their underlying profit took a hit due to weak sentiment in Indonesia and Hong Kong outlets. But hey, let's be real here, no company can be a winner across the board all the time. It's all about adapting and finding ways to bounce back stronger. Speaking of bouncing back, let's talk about DFI Retail's key associates. Maxim's had a flat profit growth, which isn't ideal, but it's not the end of the world either. On the other hand, Yonghui and Robinson's Retail both saw their profits grow. That's the beauty of having a diversified portfolio. When one part struggles, another can pick up the slack. Management has provided guidance for the upcoming fiscal year, and they're expecting an underlying profit attributable to shareholders to fall within the range of $180 million to $220 million. Now, that's a pretty wide range, but it still gives us a good idea of the company's potential earnings for the next year. And let's be real, any profit figure within that range would be considered a solid performance, especially in the current economic climate. But here's where things get really interesting, my fellow iguanas. DFI Retail's share price is currently trading at an attractive 11 times its projected earnings for the fiscal year 2025. Now, for those of you who aren't familiar with the P/E ratio, it's a widely used metric to determine whether a stock is undervalued or overvalued. A lower P/E ratio generally indicates that a stock is undervalued and potentially a good buy. In this case, DFI Retail's P/E ratio of 11 is considered quite low, especially when you compare it to the implied target P/E of 15 times. This target P/E is essentially what analysts believe the stock should be trading at based on their projections and valuations. So, with DFI Retail's current share price being significantly lower than the implied target, it suggests that the stock may be undervalued and potentially a bargain for investors. Now, I know what you're thinking, but Iggy, what exactly does a P/E ratio of 15 mean? Well, my friends, it simply means that if you were to buy DFI Retail stock at that valuation, it would take you 15 years to earn back your investment through the company's earnings. Of course, this is just a rough estimate, but it gives you an idea of how the stock is valued relative to its earnings potential. Let me expand on that juicy detail about DFI Retail's target price and potential upside. Analysts have recently adjusted their target price higher for DFI Retail shares, primarily driven by the strong performance of one of their key associates, Yonghui. The new target price sits at a tasty $2.81, up from the previous $2.80. Now, this might not seem like a massive jump, but here's the kicker: at the current share price, that new target represents a mouth-watering 44% upside potential. Imagine your investment growing by nearly half its value. That's some serious capital gains right there, folks, but wait, there's more. On top of that tantalizing upside, DFI Retail is also offering up a delicious 6% yield for the upcoming fiscal year 2025. That's right, a 6% dividend yield, which means you'll be earning a steady stream of income just for holding onto those shares. It's like having your cake and eating it too, capital appreciation and a juicy dividend payout. Talk about a win-win situation for investors. And there you have it, my fellow iguanas. DFI Retail Group is a force to be reckoned with in the retail world, and their impressive growth and attractive valuations make them a company worth keeping a close eye on. But don't just take my word for it. Do your own research, stay informed, and always invest responsibly. Remember, investing is a marathon, not a sprint, and the key to success is patience and a solid strategy. If you found this analysis helpful, do me a solid and smash that like button. And if you haven't already, hit that subscribe button and ring the bell to stay up to date with all my latest investing insights and financial wisdom. Until next time, this is Iggy the Investing Iguana, signing off and wishing you all the best on your journey to financial freedom.